Right now, an event of potentially historic financial significance appears to be unfolding, drawing intense scrutiny from a global community that has waited for years. This moment centers on two currencies, the Iraqi Dinar's IQD and the Vietnamese Dong A VND, whose long-anticipated revaluation has been the subject of countless private discussions and media speculation for over a decade. The narrative that has often been dismissed by mainstream finance as merely a rumor now seems to be confronted with what is described as concrete, verifiable data emerging from within the secured walls of major financial institutions. For millions who have held these currencies, believing in a future shift, this development represents a profound turning point. The core of this current excitement stems from reports that fluctuating exchange rates for both the Iraqi dinar and the Vietnamese dong are allegedly being displayed on real internal banking systems within the United States. This distinction is critical. These are not mere speculative figures or unverified third-party screen captures circulating on social media forums. Instead, sources close to the situation suggest this data is appearing inside the secure platforms of Tier 1 U.S. financial institutions, platforms which typically only reflect official rates once they are fully authorized for public readiness or internal testing. This development, if confirmed as widespread and accurate, would represent the most tangible sign yet that the financial infrastructure is being actively prepared for a major currency shift. For years, the community dedicated to tracking the potential global currency reset and the revaluation of these two specific currencies has operated largely on faith, hope, and anecdotal evidence. Countless late-night conference calls, anonymous intel drops, and endless hours of discussion were all anchored by the single, unyielding belief that the official worth of the IQD and VND would one day reflect their national economy's underlying assets. Holders of these notes, who purchased them and safely stored them sometimes years ago, were consistently challenged by skepticism and ridicule. The emergence of live exchange rates within secure banking environments is being framed by this community as a moment of profound vindication, suggesting that their patient waiting is nearing a potential culmination. The nature of this alleged visibility within banking systems carries significant weight in financial protocol. When a bank integrates a currency onto its internal rate screens, it signals that the entire processing infrastructure is being geared up for action. These are not static, placeholder values. They are purportedly active data feeds connected to liquidity and settlement systems, a process that necessitates higher-level authorization. Such preparation often involves central banking authorities, and in the context of U.S. institutions, may require coordination or oversight from bodies like the U.S. Treasury to ensure compliance and stability during the eventual public rollout. This is being interpreted as a definitive indication that the necessary financial gears, which had long appeared stalled, are now fully engaged. This accelerated activity over the past 48 hours is what has amplified the immediate focus on this event. Insiders from multiple, distinct financial institutions are reportedly confirming this live exchange rate visibility across secure platforms, suggesting a coordinated, rather than isolated movement. The implication is that a deliberate process is underway, preparing the banking networks for a significant shift in foreign currency handling. In the perspective of those tracking this development, this synchronization across various platforms means the preparatory phase is well advanced, and the system is moving toward its final readiness stage for public action. The most immediate question, following this internal development, is the timeline for public access. Historical precedents in global currency events suggest a potentially short window between internal bank visibility of new rates and their public release. Once live rates are securely tested and displayed internally, the transition to public redemption is often a matter of days or, at most, a few weeks. This perceived short time frame is why the entire community remains on high alert, with eyes fixed on any further institutional signs or official announcements that would precede the widespread availability of these rates to the general public. The proximity to a public event is considered a key factor in the current surge of attention. In terms of specific figures, reports circulating within the financial network suggest an indicative rate for the Iraqi dinar potentially ranging between a 3.71 and a 4.25 USD per dinar. Concurrently, the Vietnamese dong's indicative rate is reportedly appearing between 0.47 and the 0.52 USD per dong. It is crucial to note that these are internal indicative figures and not yet official public rates, meaning slight fluctuations remain possible before the final release. However, if these figures are accurate and hold, they represent some of the highest potential revaluation numbers ever associated with this narrative, leading to a palpable sense of anticipation among holders. To illustrate the potential magnitude of these figures, consider the mathematics. At the lower end of the indicative range, a single 25,000 Iraqi dinar banknote could potentially convert to over 9D, an enormous difference from its current market value, which is significantly lower. While these numbers are compelling, the true groundbreaking aspect for the community is not merely the potential size of the shift, but the fact that these non-public, real-time rates are allegedly existing and visible within the heavily guarded digital ledgers of top-tier banking systems, confirming the existence of a prepared financial structure. The significance of these internal rates appearing now, after years of economic and political evolution in Iraq and Vietnam, is not lost on observers. Analysts suggest this potential revaluation aligns with a broader global strategy aimed at stabilizing international currencies, rebalancing long-term trade dynamics, and potentially moving toward monetary systems backed by tangible assets. This shift is seen as being about more than just the two nations involved. It is about restoring a more accurate, equitable value to nations whose economic potential has historically been underestimated or suppressed within the global financial hierarchy. The convergence of these two currency events is thus interpreted as a sign of a much larger, systemic transition. For the Iraqi dinar specifically, a revaluation is viewed through the lens of historical context. Before decades of conflict, sanctions, and foreign intervention led to its collapse, the Iraqi currency was among the strongest in the region, once trading at levels above a 3 USD per dinar. As Iraq reasserts greater control over its vast oil and gold reserves and strengthens its sovereign banking framework, the economic stage is seen as being set for a recovery that reflects the nation's true wealth base. Therefore, the revaluation is often framed not as an arbitrary act, but as a mechanism to restore parity, aligning the currency's external value with the reality of the country's economic rebirth and booming oil exports. Similarly, the Vietnamese dong situation is intertwined with Vietnam's remarkable economic progress. The country has quietly established itself as one of Asia's fastest growing economies, yet its currency has remained at an artificially low value for a long period, primarily to boost its export competitiveness. This strategy, while successful for trade, has masked the true economic power of the nation. As Vietnam continues its deep integration into the global supply chain, strengthening its trade partnerships with major economic powers, analysts have persistently argued that a significant currency adjustment is a necessary and inevitable step for Vietnam to fully assume its role as a major global economic player. The simultaneous appearance of internal live rates for both currencies is considered by some to be a strong signal of international coordination. This dual event points toward a possible synchronized monetary maneuver, perhaps orchestrated as a part of a wider, multinational financial reset. The fact that two geographically distinct economies, both with histories of suppressed currency value, are reportedly seeing internal rate changes at the same moment suggests that a unified, authoritative decision has been made at a high international level to move these specific assets into a state of readiness. This coordination adds to the weight of the current development. Despite the monumental nature of this internal milestone, it must be stated clearly that the appearance of live rates on internal banking screens does not mean the public exchange process has officially commenced. Currently, this specialized data is likely visible only to a very select number of departments within authorized financial institutions. These typically include private wealth management, foreign currency exchange desks, and specific divisions catering to high-tier private clients, sometimes referred to informally as the Tier 4B group. These elite institutional departments are consistently the first to receive and process early data feeds during any structured financial rollout of this complexity. The next critical phase to monitor is the public release. This is the moment when official government and central bank announcements will be made, Formal exchange protocols will be disseminated, and official appointment systems will be made available to ordinary currency holders. Until that stage is reached, the most crucial tools for those holding dinar or dong remain patience and thorough preparation. Rushing the process prematurely or acting on unverified public speculation could prove counterproductive, underscoring the need for discipline. In light of this heightened activity, the guidance for holders is to focus entirely on organizational preparedness. This includes ensuring that any physical currency held is securely stored and readily available for official authentication processes. Warnings regarding an increase in scams are also paramount. Any request to send currency to a third party claiming early exchange access should be treated as fraudulent. The legitimate exchange process, when it does arrive, will invariably flow through authorized, officially designated banks or redemption centers with clear, secure procedures. The infrastructure required for a large-scale, controlled financial operation of this nature is immense. Reports suggest that banks are actively receiving updated procedural memos, undergoing specific training, and being instructed on how to handle high-value exotic currency redemptions. This language, referencing high value, is a key indicator that the operational side of the banking system is being adjusted for an influx of volume. Some sources even hint at financial institutions conducting internal simulation runs to test the transactional flow through the newly adopted financial architecture, a definitive sign of late-stage readiness. This discussion often leads to the topic of the quantum financial system, or QFS. This proposed blockchain-based global settlement network is theorized to be replacing legacy banking technology, promising greater transparency and instant, asset-backed settlements. While no official confirmation links the QFS directly to the IQD and VND revaluation, there is a growing body of anecdotal evidence suggesting a connection, such as reports of banks quietly implementing new digital identification and quantum encryption tools for upcoming transactions. The currency event is thus seen by many as one of the first major public manifestations of a broader, evolving global financial system. Historically speaking, the period between the internal confirmation of live rates and the granting of public access is highly variable but generally brief. The current circumstance, involving simultaneous reporting from multiple, seemingly unrelated institutions, suggests a high degree of coordination that transcends a single bank anomaly. While exact dates are impossible to confirm, the overall timeline is speculated by some to be pointing toward a broader movement, potentially accelerating in the coming weeks. The crucial takeaway is the undeniable evidence that the structure required to manage a significant wealth transfer is approaching full operational status. This development serves as an early alert, not a prompt for immediate action, but a reminder to finalize all personal and financial arrangements. Holders are encouraged to gather all necessary documentation, review their personal and business tax strategies, and consult with financial and legal professionals who specialize in wealth management and complex asset structures. The opportunity that this event potentially presents is considered life-changing, but realizing its full potential will be entirely dependent on the strategic planning undertaken by individual participants in the lead-up to the public release. It is important for all participants to maintain a generational perspective regarding their financial planning, rather than focusing solely on a short-term cash-out. The objective, as often articulated by financial educators in this sphere, is to leverage the opportunity to build a lasting legacy. Decisions should be guided by clarity and sound strategy, not by the circulating hype or underlying fear that often accompany massive financial events. A structured, well-thought-out plan will always yield better long-term results than any impulse reaction. One of the largest misconceptions is the idea that all redemptions will occur simultaneously. This is highly improbable. Any process of this scale will be managed and staged. Banks are expected to control the flow of transactions through a structured system of scheduled appointments, likely prioritizing based on volume, verification requirements, and security levels. Therefore, hearing about an early appointment should not cause panic. The process is designed to be orderly and secure for all participants, with each wave of holders eventually being accommodated by the system. The immediate 72-hour window following the initial reports is considered particularly crucial. This is historically when internal updates and confirmations accelerate and systems are refreshed across various institutions. If these active live rates continue to hold and expand across multiple business days, it would be viewed as the definitive confirmation that a real, imminent event is underway. Staying informed and prepared remains the only sound strategy for navigating this moment safely and successfully without relying on unchecked speculation. Finally, it is essential to remember the broader, transformational narrative at play. This potential revaluation symbolizes more than mere financial gain for individuals. It represents a significant step for nations like Iraq and Vietnam to reclaim their rightful status within the global economy. It is viewed as a move toward greater transparency, fairness, and economic sovereignty within a global system that many have long considered imbalanced. The rise of these currencies is not just a numbers story, it is a powerful symbol of a greater shift toward global economic cooperation and equity. For those who have navigated years of doubt, skepticism, and endless delays, this moment stands as a testament to perseverance. The patience demonstrated by these currency holders, who maintained their belief in an event most people dismissed, may soon be rewarded. The evidence, live internal rates, confirmations from multiple institutions, and systemic readiness is considered clearer than it has ever been. The focus now shifts from hoping for a change to meticulously preparing for its successful execution, recognizing that the revaluation of the Iraqi dinar and Vietnamese dong is seemingly transitioning from a theoretical possibility to an impending reality. This is a moment where hope is powerful, but preparation is truly priceless.